People still have this idea that there is a way for the loan officer to charge you a much worse rate in fees and make a bunch of money on the loan.
There's really two ways a lender can get paid.
An origination fee. People always ask, what are your origination fees?
Underwriting
fee, admin fee, doc fee, yield spread, or rebate. Borrowers have probably more commonly heard of it as a rebate. The only way you're getting the lower interest rate is for you to pay that point. That is the most common scheme if you are looking with an online lender that's really big.
How much is your lender making by doing your loan? Should you actually care? Well, in today's video, we're going to talk about how your mortgage lender is getting paid when they do your loan. So Josh, this is one of those topics that comes up often. People ask, how much you're making. I think it's relevant to kind of dive into some of the details here, Josh. Let's talk about it in a little bit more detail. It doesn't matter how you get paid. Should somebody, see the amount that you're making? Where should we start?
Well, some of this, Jeb, is a remnant of the old system prior to the TRID guidelines, the loan estimate, the closing disclosure, all of that. Because we've talked about this before. I started doing this in the 90s, and I would talk to people, give them a really good quote. We go through the numbers and say, hey, just got a much better quote here. This guy's going to do it 0.5% lower. He's not charging me anything. And you get a call about 3 weeks later, and they were right before closing, and they're like, you got to help. Everything's changed. The rate is 1% higher. I'm paying $10,000 in closing costs. Prices were much lower then. They might have been paying $5,000 in closing costs, but that was the panic. So people still have this idea that there is a way for the loan officer to charge you a much worse rate in fees and make a bunch of money on the loan. And I will not say that there aren't some small renegade shops out there running that way. But the loan officer compensation guidelines are very clear. You can't be compensated for terms of the loan. It can't vary from loan to loan. I can't do a loan for Jeb, my buddy, and make $500 and do it for Susie that comes in and charge her $50,000. Again, could someone do it? Could someone do it outside of the laws and the guidelines? They absolutely can. It is very unlikely. The costs of doing that are large in terms of fines, losing your license, everything. So let's go back. Does it matter? It matters because there are certain shops that have high comp. There are certain shops that have lower comp.
Well, explain that, Josh. Explain what that means.
So, as
in a little bit more detail. Yeah.
Some of these lenders will allow you. So let's say that Jeb works at lender A and Josh works at lender A also. That doesn't mean that our rate sheet's the same. It doesn't mean that our comp is the same. When we get hired, my contract says I expect to make 2% of the loan amount, and I'm going to have a really ugly rate sheet. Jeb might go in and go, I got low overhead. I'll make 0.5 point on those loans. And he's going to have a hot rate sheet within that context. So there's differences even within lenders at the same shops. So let's go back before we break this down of how it works and how you actually get paid and talk about what we talk about on the show all the time. We get a lot of inquiries. And we ask on there, what's your biggest concern? What would you like us to discuss? And the number one thing that shows up there is getting the absolute best interest rate. Is that the right question? It is important that you get a fair and competitive interest rate, but getting that rock bottom low interest rate could lead you inadvertently to one of those shops that does play fast and loose with the rules and kind of moves things around. So we're going to show you what to look for, where to look for it. But let's go back and use this example because there's a small subset of those people that will reach out that they'll call, hey, will you look at this loan estimate from this person? I don't see what they're making and I need to know what they're making on my loan. I say, why do you need to know what they're making? Why do you know I'm getting a good deal? It's not relevant to you getting a good deal. And let me put it to you this way. If I made $50,000 for doing your $400,000 loan, that's a massive, monstrous, insane commission that no one would ever make. But if I did that and you got a 1% 30-year fixed rate, would you care that I made the biggest commission in the history of a $400,000 mortgage? No, you wouldn't care because you got the best terms available. Better terms than are available. So it's not relevant to whether you're getting good terms, but we're going to go through so you can understand exactly how your loan officer gets compensated. We may even talk a little bit about the guidelines and regulations that have made it where in the 90s when I started, there was no internet. There was internet, but people weren't using the internet to shop for
Al
mortgage
Gore
rates.
hadn't invented the internet yet.
Al hadn't invented the internet yet. So it was there, but people weren't posting mortgage rates. So you didn't have a really simple sample place to go and compare. So lenders could be 0.5% different, 0.75% different from one lender to the next. I say today that all reputable lenders are going to be within 0.125% in interest. So if someone's quoting you 0.25% higher, we had a listener right now, Jeb, telling us that their lender in Texas is telling them 0-point VA loans are at 6.75%. And that's insane. So they're out there, but they are few and far between. And on the other side, if you talk to 3 lenders and they all tell you, hey, your 0-point rate should be 6%, and you talk to another guy who goes, I can do it at 5%. Not likely that that person is telling you the truth on either side. You may want to believe that. You may want to hear it. And I suppose there's some strange circumstance where that could be true. But 99% of the time, it just means they're not telling you the truth.
Yeah. And there's a lot of changes happening in the real estate industry with regards to commissions, how myself as an agent gets paid representing buyers. It's been pretty transparent online, over the last couple of years with listings, how much, it's been posted online. The listing agent, it's kind of, it shows up on all of these websites. So there's a transparency on the real estate side, or there has been a lack of transparency for the longest time. And now it's really, really transparent in what everybody's making. And I think the concern for some buyers on the mortgage side is there isn't transparency. They don't know what's happening. And therefore, it's this kind of unknown. Am I getting ripped off? Am I not? And so with that, we want to go to, in a little bit deeper level here and talk about how lenders get paid, because there's multiple ways that a lender can get paid and how you as a consumer can look at it in more detail just to make sure you're not getting ripped off. Now, on the same note, if you want to stay updated on changes like this, everything happening in the real estate market, do us a favor, subscribe to the channel. And if you find any value in today's episode, do us a favor and hit that thumbs up. So Josh, there's really 2 ways a lender can get paid. And instead of just giving it all away, why don't we start with way number 1? What is the most common way that a lender gets paid? How do you get paid typically?
So all of the direct fees that you're going to see, we talk about the loan estimate, we talk about box A of the loan estimate. So everything that we're going to talk about, if it's a direct charge that you're paying, is going to show up in box A of the loan estimate. So an origination fee. People always ask, well, what are your origination fees? For us, we never charge an origination fee. You may, the next thing we're going to talk about is pay discount points. So you may be paying points, and this is where it can be confusing for people because an origination fee is generally listed in terms of points as well. So I have a 1-point origination fee. I have a 2-point origination fee. I have a $1,000 origination fee. That fee listed that way is truly money going to not directly to the loan officer. We don't know what the loan officer gets of this, but to the originating mortgage company. They are collecting that as a fee, and it is generally going to go into the commissionable fees that would go to your mortgage loan officer. Not directly, but a percentage of that would be included in that. It is not necessarily the only thing, and that leads, let's answer our question, is one of the biggest questions that I get. What is a point? What is a discount point? What is a point? Why is a 1-point origination fee? Let's make it super simple. A percent. A point is a percent. So if I say 1 point, I'm talking about 1%. Percent of what? Percent of your loan amount. So if you're getting a $400,000 loan, and like in the example we used before, that's $4,000. That's a lot of money. I don't care who you are, where you're at, $4,000 is a lot of money. So we're going to ask ourselves, should I be paying that? Is that the right way to structure this loan? Should I have a $4,000 fee in box A? There are lenders that will put a $1,500 origination fee. Well, we only have a $1,500 origination fee. They quote it in dollars instead of points. But most commonly, you're going to see it as points. And when we get to discount points, also listed as points. So just remember, they're a percentage of the loan amount. And it doesn't mean when we say a point or points that it's always exactly 1%. It could be a fraction. It could be a decimal. So it could be a 1/2 of a point, 3/4 of a point. It could be 0.625 points. It could be 0.749. Crazy numbers that you've never seen. It's just that is a percentage of your loan amount as a fee that you are paying on your closing statement.
So Josh, if you're saying you never charge points on a loan, how is it that you get paid? Right. So there's upfront points that someone can charge, and kind of tagging along to that, it could be things other than points, right? It could be listed as a processing fee. It could be listed as a tell me a fee, Josh. I mean, you see more of these than I do. What do people try to hide
underwriting
points
fee,
as?
admin fee, doc fee. The craziest one, Jeb, it was a listener to the show, sent in their loan estimate for us to review. And I'm looking going, that is mind boggling. I can't believe what I'm seeing. It says Encompass technology fee. Encompass is the horrific software that 90% of mortgage companies, including unfortunately this guy, uses to process your loan. And it's expensive. But they basically were charging $100 on every file for you to pay for the software that they use to do their jobs. And my first response is, Jeb, that's insanity. But the second response is, I don't care. Let's go back to that idea of box A of the loan estimate. It's going to have all of the line items that you just mentioned. It could be completely empty, in which case it's going to put a total at the top of 0. It could have one fee. It could have 14 fees in there. I don't care what they are, what they charge, what they call them, but look at the top of box A and it's going to have a total. And if it's $2,000 or $8,000 or $1,500, that is the cost for that interest rate. I think that is the best way to look at it versus getting hung up on, they're hitting me with junk fees. Mm-hmm. The current administration in the White House is on a battle against junk fees. You can call them junk fees all you want, but every lender that you're shopping with has overhead and they're looking to create compensation that will cover that overhead. If they want to list it out as 7 line items and another lender wants to put just one simple line item, I prefer simplicity. I would like it to be as simple as possible, but there can be anywhere from 1 to 7 items in box A. I don't care, and I don't care what they're called. That is the total. I would consider that points. So that is the cost. And don't even get hung up on points. Is that an origination fee? Is that discount points? Is that junk fees? Is it underwriting fees, admin fees? Just say, this is the cost in points for the interest rate that I am getting.
Got it. And so with that, if you're watching this, I'm going to link to an episode where Josh and I actually went into detail about the loan estimate, because there's more than just box A on the loan estimate. And as a buyer out there, it's important to understand what you're paying outside of box A. And in that episode, we actually go into it in a lot of detail. So if you're interested in learning more about it, do us a favor and check out that link above. So Josh, you said 2 things that are interesting. The first one is somebody sent in their loan estimate to us to review. So that's something that you and I offer. If, more so you, because I don't do loans, but as a partner with you, if you're interested in having someone review your estimate to make sure you're getting a good deal, or if you're just starting the process and you're looking to work with professionals from the get-go, do us a favor, reach out. There's a link in the description of this video where you can actually get in touch with us and, have us not only review your estimate to make sure you're getting a good deal, but we're willing to offer you competitive terms too if we can do the loan. And if you're getting a great deal, we'll tell you you're getting a great deal. You move on, you're in good hands, and all is good. So, Josh, we mentioned origination points. What's the other way that lenders get paid?
So, yield spread. Yield spread or rebate. Borrowers have probably more commonly heard of it as a rebate. So let's talk about that idea of a 0-point loan. You've all heard of 0-point loan. You may go to your loan officer and say, I don't want to pay points. I want a 0-point loan. And that doesn't mean that the loan officer is working for free. They got to get paid, right? Yep. So on any given day, there's this idea of a par interest rate for any loan program and for any borrower's qualifications. We put in your loan amount, your location, your purchase price, your loan program, your credit score, your reserves, all of that. And it spits out, the lender says, here's the interest rate that we want. We're not paying you, the loan officer, anything for it. We're not paying the borrower anything in the form of a credit to cover their closing costs. And we're not charging them anything in terms of discount points to get that. That's the par rate. So if we truly do it at the par rate, there's no money in there for the loan officer or the originating company. So they have to charge you directly. So we would go back, and that was where they would have to have an origination fee. Now, it will show either as an origination fee or as discount points, because that par rate, obviously, we are a direct lender for most of our loans. Most of the loan programs we're going to fund in our own name, and we'll make money when we sell that loan. So for us, it's truly a discount point, because we can say the 0-point rate is not a rate to us. We're not making any money, so we have to charge discount points to get that rate. So from that perspective, what you're looking at is what is the cost for that interest rate. And let's go back. We've talked about this a million times on the show, Jeb. From 1982 through 2022, we had a 40-year bull market in interest rates. In the early part of that process, loans were very small. The secondary market for mortgages wasn't very big. They were often done by banks. So everybody paid an origination fee or points, something to compensate the company and loan officer that was originating the loan. Over that 40 years, people started realizing this is dumb. In 3, 4, 5 years, I'm going to refinance. I'm going to move. I don't want to pay upfront costs. So we moved to this idea of there's a value to your loan in the secondary market. The originator, the loan officer, can do that loan for you at 0 points, and the lender that ends up owning that loan is going to pay them. So the higher the interest rate above the lender's par rate, where they're not paying anything and they're not getting anything, the more valuable it is. There's diminishing returns on that. But in general, we've talked about the cost for you to buy a rate down. It works in reverse. So the rate sheet is not always perfect like this, especially over the last year and a half or so. We get really funky rate sheets. But over time, we would say, if you want a 0.25% lower interest rate, if the bank says 6% is our par rate today, and you say, I can't do that, I need 5.75, a 0.25% lower, the rule of thumb is 1%. So if their par rate's 6% and you want 5.75, you're going to pay a point in discount to get that. So that is a bona fide discount point. Like, the only way you're getting the lower interest rate is for you to pay that point. So in general, that 0 point, you're not paying any discount to get it, but that doesn't mean that the loan officer is not making any money. Either the lender, if they're a broker, the lender they're placing that loan with, or if they're a direct lender, when they sell that loan into the secondary market, whoever's going to be the end lender on that is paying them for that loan. They say, okay, on any given day, this is what that is. We're going to give you 1 point, 1.5 points, 2 points. So the question then becomes, what is reasonable? What should it be? And we go back to that original conversation. There are places where some loan officers make less than 1 point on a loan. There are places where some loan officers make 2.75% on that loan. So is it relevant to you? It is relevant in that if you go to two different lenders and the one is, they both work at the same place, so they're working off the same rate sheet, and one of them, their expectation is at closing to make 1 point, and the other guy's expectation or girl's expectation is to make 2.75 points, it's going to be almost a 0.5% difference in that interest rate. So do you need to worry about what they're making, how they're compensated, any and all of that? No. This is where I say you're going back to box A. What are my total box A fees? And what is my interest rate? So if you get a quote and the first one is 6% at 0 points, and you go to someone else and they go, oh, I can beat that rate, and they tell you it's 5.875, but there's $8,000 in box A, they didn't beat that quote. They're charging you more. If you go back to that first lender and say, hey, you were 6% with no fees in box A. If I was willing to pay you $8,000, what's the interest rate? They're likely going to go, well, it'd be 5.625. So that is really the basis of comparison. And again, for most people, this is a frustrating experience, or it feels like a pointless experience, because we talk about it. If you call reputable lenders, it's going to be within a fairly narrow range. I say it feels like a pointless experience, but when we review these loan estimates, I would say 60% of the time, they are with one of these reputable lenders. We had a listener reach out today. I've got to get back to her. Emails in my inbox. Every detail that I read, I'm like, it's about the terms that she should be getting. And without putting it through my pricer, that is what I think I would be quoting her. So I'll go through and confirm that. But for about 60% of the people that reach out, maybe 65%, that's what we say. Hey, maybe I could save you $500 or $1,000. Maybe we would be a little worse, but we're in the range of that. So you're in the range. So the question I always ask is, do you like this person? Do you have a good rapport with them? Do they answer your questions? Do they seem to know what the heck they're doing? And if they say yes, you've got good terms from someone you're on good terms with and seems to know what they're doing, continue down that path. But I will say, maybe a third of the time, maybe a little bit more than a third of the time, it's like the guy in Texas. Like, what are we talking about? 6.75, 0 points on a VA loan today. Depending on if you're listening to this 3 years from now, that could be spectacularly high or spectacularly low. As of today, it's an $800,000 loan. I ran the numbers. The lender would be making $25,000 on that loan. That is not typical. We don't make $25,000 on $800,000 loans.
Yeah. So, I mean, if you're going through that process, just understand, right? It's taking the time to compare. We've talked about this before, not going to go into detail on this, but when you're comparing, make sure it's around a similar time. You know, you're not doing this 2-3 weeks apart in getting quotes and comparing people, because within that time frame, a lot changes. I mean, hell, last week, a lot changed within 2 to 3 days. You could have gotten a quote on a Thursday and then a quote on Monday, and there could have been a huge variance just based on those 2 days. So know when you're going to it through the process. You're talking to lenders within a short time frame, running numbers, and then comparing, looking at rate. Rate is where you should start, because that's an easy comparison, right? If all the rates are the same, then you go to box A and look at it. If one rate is significantly better than the other, why is it better? Go to box A. Look, are you paying points for that? What is happening in box A where one lender can do something spectacularly different than all the other lenders? And I think that's where people get confused is, they, like you said, Josh, they just look, hey, well, this guy offered me a better rate. Yeah, but you are paying for that. And that's okay as long as you understand what you're doing. And if that's what you want to do, then go back to the person and say, hey, listen, I'm willing to pay points to do that. What can you do? Because it could be even better in that scenario. So,
well, let's look at the flip side. And I think there's a story from a listener here that we actually closed the loan for. Without naming a name, they went to the biggest direct retail lender that advertises on the Super Bowl, and they had a very simple situation. And that lender has a great system for getting very simple scenarios through. So he calls me and says, hey, I was having a great experience. I liked the person I was working with. I got my pre-approval in like 5 minutes. I did the online application, uploaded a pay stub and W-2 and a bank statement. And they go, you're rock solid. Here you go. And they told him he's pre-approved. They told him what his payment was. Everything sounded right. They told him what his rate was. They didn't, because he doesn't have a property. That's the sixth element there that triggers an application where they have to make a disclosure. They didn't tell him anything about fees. So the rate was great. Payment was great. Pre-approval was great. Service, technology, everything was great. He sends over his contract once he gets the property under contract, and they send it back over. They wanted 1.75 points for what should have been a par or a 0-point interest rate. So he's like, no, dude, my loan is super easy. So he reached out. We looked at it. I looked at it on a Sunday. Monday, we priced it, locked it, closed it like 3 weeks later. That is the most common scheme. If you are looking with an online lender that's really big, I'm not saying there aren't any good and reputable online lenders, but the really big ones, they are sales operations. They train their sales teams. Hey, we do not have the best rates and fees. So do not quote rates and fees. Quote a really good interest rate that's going to have 1 to 2 points cost to get it, get them as far down the line, and then we're going to send that loan estimate out and hope they don't notice. So it really does come back to, at that point, don't concern yourself with what the loan officer is making, because in those big call centers, those loan officers are expected to do 20 to 30 loans a month because they're getting fed a massive volume of leads. They might only make $500 for doing your loan. When I did that loan for that customer, probably made $4,000 on it versus the $500 that Rocket was making. But the difference was it was 1.75 points on a $500,000 loan. It was $9,000 cheaper to the borrower. Does he care that I made $4,000, or is he happy that he saved $9,000? That's what I'm talking about. You don't have to know all of that behind the scenes of what's going on to look at your rate and your box A charge for that. And that's what you are shopping for.
No, and one thing that you said that made me think, Josh, is if you got a quote from a lender a month ago, and now you found a property you've been shopping, and you go back and your rate is exactly the same, could be a little bit weird, right? I mean, just check, right? Make sure, because rates change daily. Would it be completely crazy to get the same rate? No. But, rates could have gone down and they're still quoting you the same rate. And now it's just, they're making more money by doing it. And not to say that people do that, but it's we have this podcast for a reason. It's the Educate Homebuyers. And this is merely what we're doing, is just making you guys aware of things that you should be aware of so that you can make better decisions. So with that, I want to add one more time, if we can be of any assistance to you, we would love to guide you through that process. Use that referral link below. Let us look at your estimate. Let Josh look at your estimate, and ultimately guide you guys to the finish line. So Josh, if somebody's out there right now in this process, any parting words that we want to add today?
Make sure that pre-approval process, even if you're not a shopper, you don't want to shop, that pre-approval process needs to be complete. What's the maximum you qualify for? What's the monthly payment? How much cash do I need, including what are we charging for today's interest rate? So it's not enough to find out what is the interest rate, is the box A cost for that interest rate. And I think we've done a pretty good job here with the show, Jeb, because about 85% of the people I talk to from the show, they always want to ask, awesome, okay, that's a great rate. What's my box A charge for that? Perfect. And we go through it and they know it's competitive, but that's the way you know that you're getting competitive terms. And kind of the last piece of information, once you've determined you're getting competitive terms, please make your decision based off of the knowledge, expertise, of the loan officer and your rapport with them. Make sure you like them. You're going to be dealing with them closely. They're going to be going back and forth with you throughout this process. It's going to be stressful. It's going to be emotional. You need to be able to talk to them, and they need to be able to get you the right and accurate answers in a short time frame when you're in the process. That is far more important than trying to find the guy that is 1/8 lower in interest rate than everyone else you're talking to.
No, good stuff. Now, if you have, we would love to know your thoughts on episodes like this. Do us a favor, comment below. And if there's something you want us to touch on, you can also leave it in the description or in the comments of this video. But until next time, guys, buy right, borrow smart, build wealth. Adios.
Amigos.